5 software stocks that I will be focusing in 2024. Private equity firms and institutional investors, they love software companies. Why? Because there are mainly 4 reasons. Reason number 1 is that their revenue is predictable. Reason number 2, they have better capital efficiency. Number 3 is their success can be measured easily. And number 4, the companies can scale much faster than your traditional companies like Apple, Nvidia, Tesla, or name any of those companies. Even companies like Apple and Tesla, they are focusing a lot in their services side of the shop so that they can build a good, robust income stream. When it comes to software companies, these companies can scale much faster with a lower overhead cost as compared to manufacturing companies. And this is the main reason why I will be focusing very heavily in software companies. So if you do not have that in your portfolio, maybe it's time you consider adding software businesses in your portfolio for long-term growth. So in today's video, we are going to cover 5 different stocks from 5 different industries. So number 1, we will be talking about companies that are in automation industry, companies that are building software platforms, companies that are dealing with cybersecurity, companies that are dealing with identity solutions, and companies that are dealing with analytics. They are also in different shapes and sizes, which means that they are anywhere between $7 billion in market cap, going all the way to about $40-50 billion in market cap. Stock prices are anywhere between mid-20s all the way going to $200. So you have a lot of options on the plate to look into it. Now, these are some of the picks that I have selected for my portfolio that I would love to add in the coming days, weeks, and months. You can also look at their competitors. There are other options out there in the market, but something I wanted to bring to your attention. If you end up enjoying today's video, make sure you give us a like. And without further ado, let's dive in. Everything will be time-stamped here, so feel free to jump this section and go straight to the stocks. But the 4 main reasons why private equity and institutional investors love in software companies is number 1 is their predictable revenue. It basically means that the software companies, they can take on more customers without increasing too much of their fixed cost. And that is one of the best models that you have. So for example, in a traditional company, if you're selling a physical product and you have a higher demand, then your infrastructure cost, your production cost, your labor cost, that goes up as well. In software's example, you don't have much of a problem like that. And in addition, software companies are able to upsell to their existing customers by offering them different modules of their product itself. And that can increase their monthly revenue, or they can increase your annual recurring revenue. Second reason is their capital efficiency. What private equity and institutional investors love, that the software companies are able to use their dollar much more efficiently as compared to other startup companies or even other manufacturing companies. And this is one of the reasons why software companies are so attractive to the investors. Number 3 is measurable success. Because they are selling softwares, they are increasing their customer base, there are tons of metrics that you can track a success of a software company as opposed to more traditional firms that are into manufacturing. And number 4 is scalability. A software company can scale their business model much faster, much easily as compared to manufacturing companies. Physical barriers like infrastructure does not exist in the software side of the shop as opposed to those manufacturing companies. And these are some of the main reasons why software business is so important to have a place in your portfolio. Now, we are all very familiar with these big 7-8 companies like Apple, Microsoft, Amazon, and so on and so forth. Sometimes we get so engrossed with these big 7-8 companies that we actually forget that the software business model is a great business model and can generate a lot of revenue and returns for their stakeholders. The first stock on the list is UiPath, ticker symbol PATH. We have covered UiPath a couple times on the channel, so I will put the link somewhere over here. You can definitely check it out. They are the market leader when it comes to the robotic process automation software. So in simple terms, an RPA software helps you to automate all your process steps that are done by white collar professionals. Currently, the stock price is about $25.04. The stock ran up 26% Friday itself, and the stock is up $5.28. Year to date, this stock has doubled. It's 103% they have gained for this year. Now, because of the recent surge in the stock price, the market cap of this company has gone up to about $11.2 billion. And currently, the short interest on this company is about 9%. In the last 12 months, insiders have sold about $16.19 million worth of stocks in about 32 transactions, and there are currently 0 buys so far. Now, why did the stock ramp up so much? It is because they reported a Q3 beat on their earnings, and the main reason that they got such a good review by the analysts is because their free cash flow estimates are higher. Analysts have much higher conviction in the growth of the company. And what has really helped UiPath in the recent quarters is their inclusion of artificial intelligence in their robotic process automation workflow. Looking at their recent earnings, they announced on November 30th, they beat the EPS by 5 cents and they beat the revenue by 10.3 million. So that is amazing. Now for next quarter, what is estimated is that they will have an EPS of about 16, which is non-GAAP, and their revenue will go up from 325 to 383 million. So we'll see how that performs, which means that they will have to increase, either they will have to acquire more customers faster, or they will have to do upsell and cross-sell within their existing customer base. And we'll see how that plays out. In reporting their earnings since 2022, they have not missed a single EPS and they have not missed a single revenue. This gives more conviction to shareholders and potential shareholders in the future. I made a video about the 5 AI stocks and UiPath was part of it. You can definitely go check it out. I'll put the link right here. So with that said, is it a right time to buy the stock? I tend to avoid stocks when you have these major gap ups, because now you want to see what will the trend be. And what I mean by that is that are we going to see further gap ups from here, or was this a flash in the pan, and once the volume starts dying down, the stock will come back to ground reality in the range of about $18-20 or so. So with this gap up, the valuation changes of the company. So when you were buying the stock for about $17-18, that was much more attractively priced. At 25, it's up to you based on your analysis how you would want to see. At this point of time, since I'm a more technical investor, I like to see the stock finding a good resistance and support line before starting the position. Both on the MACD and RSI, the stock is in the overbought territory, and we will probably see some kind of consolidation at some point in time. Also, because of this massive trading that happened on Friday due to the earnings, the average volume jumped up from all the way somewhere trading between 3 to 7 million per shares per day to all the way to about 53 million. And we generally see that happens during the earnings season. So that's the reason why UiPath is on my radar, that where I would be looking to opening a position, but I would be more inclined to see once we find a good trend on this particular stock and see if there will be a retracement to about $20 or so, or would we see further leg up. Based on that, I will make an assessment on how much I'm going to be investing as part of my first tranche in UiPath. The second stock on the list is Gitlab, GTLB. Gitlab offers a DevOps platform for software developers. This company is valued about $7.4 billion, and the current short interest on this company is about 8.45%. So it's very similar to UiPath, which has about a 9% short interest. Currently, the stock is also very close to its 52-week high. Stock is trading at $52.47 at the time of this recording. This stock was also up on Friday for about 8.5%, and we saw year to date the stock has gained about 19%. Keep in mind, Gitlab will be reporting its earnings on Monday. In their last earnings report, they had a beat in the EPS and they had a beat in the revenue as well. This coming earnings, their EPS estimate is about -1 cent and bring 141 million in part of the revenue. Similar to UiPath, they have never missed their EPS and revenue beat, so which means that they are doing a good job in assessing and providing the guidance to the shareholders and analysts. Now, unlike UiPath, from an insider buying selling standpoint, we see in the last 1 year, we see about $63.44 million of stocks that have been sold, but at the same time, there are investors that they have bought 71.69 million worth of stock. However, for the last 3 months, we have not seen a single buy, and we have only seen sell of about $36 million. In the last 1 month, we did see the CEO selling off. We had 3 main transactions in the last 1 month, totaling about $8.29 million. Similar to UiPath, Wall Street also has a buy rating on Gitlab. We have about 11 strong buy with 4 buy and 7 holds with 0 sells. And the current average price that they are expecting the stock to be is about 59. So you have about an upside of about 12.77% in the next 1 year, with a high of being 70 and a low of being 48. Now, during earnings, the implied move of this stock could be anywhere between 15% to about 19-20%. So be very, very careful, because we have seen many times that you can see these major gap ups, or you could see some major gap downs if the earnings does not come as expected. We see 53.88 has seen a resistance for a long time. I would say going back all the way to mid-June. Since then, we have broken this few times, but have failed to break it cleanly, and we have slid down many times. Now, there is a chance with the earnings coming up, we could see a major gap up here if they report earnings better than expected and they can surprise on the positive side. We could also see if the earnings do not have a good result, we could see major gap downs. As usual, you will see volume spiking crazily on the earnings day itself. From an investment standpoint, I would definitely not be starting my position during an earnings, because what you want to do is you want to see the earnings complete, let the traders get shaked out, let the stock find its rhythm from a resistance and support line, and that is the time that you start initial position. The stock number 3 is Okta, ticker symbol OKTA, and this is one of the stocks that I'm looking to build a big position in the coming quarters. Now, most recently, Okta had a controversy because they had a breach. However, we have seen breaches happen with many companies. You even have breaches with the government agencies also. Now, that's not to say that it is okay to normalize these breaches, but the response from Okta was phenomenal on how they approached their breach. This is a $11 billion company, which is similar to the last two stocks that we talked about $7 and $9 billion, so about similar range. The stock is trading around $73.63 at the time of recording. This stock was up 9% on Friday as well. This stock trading somewhere around the middle of their 52-week range. So year to date, this stock is only 5.87%. So what does Okta do? Okta provides enterprise companies with their different identity solution options. Wall Street also has a buy rating. They have 16 strong buys, 3 buys, 23 hold and 1 sell. They are currently estimating the stock to be on average be about $84, which would give you an upside of 15+%, and the high could be 120 and low could be 64. Also recently reported their earnings on 11/29. They had a beat on both EPS and revenue. In the earnings call, their future guidance was a little bit softer, and that's why you saw a dip right after they reported earnings. But on Friday, every single stock was up, so they pretty much gained. Just like the previous 3 stocks, you can see they are continuously beating on the EPS and continuously beating on the revenue. They went IPO. They were bringing somewhere in the range of 115 million a quarter. Now it is up to $584 million. So you can see the growth in revenue this company is doing, and they were at a loss of -0.04. Now they are bringing positive EPS of 44 cents. So this is another business which is growing at a very breathtaking speed, and something that I really am looking to build into my portfolio, considering software businesses provide such a big scalable and profitable business model once the software gets adopted by the industry. The short interest on this company is only 2.86% as opposed to the last 2 stocks, which had about 9% or so. In the last 12 months, we have seen 4 sell transactions worth about $475,000. We did see the chief legal officer and the CFO selling a couple of their stocks. Similar to all software companies, you can see Okta also has a habit of doing major gap downs and major gap ups, especially during the earnings. And in this previous earning, actually, for a change, we actually did not see any major gap ups or gap downs. So that is very interesting. We did have a very strong candle. The stock is trading below its 200-day moving average, and generally if you are going to start a position in a stock, actually buy stocks when they are below their 200-day moving average. We also see there's a lot more buying that comes in around the $67 mark. The volume did spike up since the earning has been reported, and once the volume stabilizes, I would be looking at building out the support and resistance, and then where I will be looking to open my first position with Okta as well and build out throughout the next year to prepare myself for the major growth that this company is going to have in the coming few years. The 4th stock on the list is a company called Datadog, ticker symbol DDOG. Datadog is an analytics platform that helps to monitor and control the security platform for cloud applications within enterprise. So many medium and large enterprise companies have a lot of softwares that operate on the cloud platforms, and they need something like Datadog as a service to help them monitor it. Currently is a $38 billion company. Stock price is closer to its 52-week high. Similar to Okta, very low short interest with only 3 3.06%. But in the last 12 months, we have seen 285 million sell with only 13.33 million buy. Datadog reported earnings a little bit earlier in November. They had a beat on their EPS as well as revenue. Their next earnings will be in the beginning of February. You can see that they brought the 547 is what they brought this quarter, and they're expecting it to raise by to 568 million. Similar to the last three companies, Datadog has also not missed their EPS and revenue, and this is the reason why I'm really loving software companies, because they are able to predict more accurately how much revenue they're going to be bringing, and this gives you a leg up as opposed to other businesses where it is hard to sometimes predict. Now 2023 was exceptionally a hard year for software companies because when there is a higher interest rates, enterprises generally tend to start to save money, cut on IT cost, and so on and so forth. Similar to all the previous three stocks, this company also has a buy rating from Wall Street. We have 16 strong buy, 9 buy, and 14 hold with 0 sell. Your average pricing would be about 116. So you could see a downside of 2%, and the high it could go to as much as 140 and the low to about 95. You can see we have this major gap up after the reported earnings. And since then, the stock has been making newer highs. However, on the volume profile, you can see as they start going higher, the volume starts dissipating. This is the level around the 120 is when they had their peak back in last year, August. And this will be a resistance level that they will need to break. Considering how much the stock has run up since the start of November, we should be waiting to see if there would be a pullback. I'm going to be opening a position. I love options, so I will definitely be looking at opening cash secured put. But currently the stock looks like a little bit more richly valued. I still want to see the trend, and as they say in technical analysis, trend is your friend. I want to see if 120 remains as a resistance for the stock. Do we see a pullback? Do we see the stock price coming and respecting their moving averages, or the stock can keep continuing this trend? I would be looking to add the stocks around this 91 to 98 region where we see the most of the buying happening. We'll see how that plays out. The last stock on the list is ZScaler, ticker symbol ZS. The stock price is a 198.03 at the time of this recording. This stock is also trading very close to its 52-week high, market cap of $29.3 billion. So pretty large company, and they have a short interest of 6.55%. Year to date, this stock has returned 79%. So very, very handsome return. Similar to all the previous stocks we talked about, also reported earnings on 11/27. They beat the EPS by 18 and revenue by $23 million. Phenomenal earnings history. Not a single miss on EPS, not a single miss on revenue. This company in 2019 brought $74 million in revenue. Look at where they're sitting. They're sitting at almost $500 million. They will actually break the $500 mark in next earnings report. So phenomenal company in the cloud security space, something that you would love to own. Wall Street has a buy rating on this company with 23 strong buys, 6 buys, and 12 hold ratings. The average price target is about 205, so you will probably not see much upside, and this is one of the reasons. So a lot of the stocks that we talked about on the channel today, they are very close to their 52-week high, so you don't have much of a room to run. Not to say that the stock cannot make new highs, but with the general environment itself, higher interest rate, prediction of recession coming next year, discussion between soft landing and hard landing, all those things do have to play in your investment thesis, especially when you're starting new position on software companies. So insiders have sold $26.6 million versus only bought 543. In the last month, we had 11 transactions of 3.84 sells, and we had individual directors mostly selling off their stocks. We saw these major spikes in volume as usual we see during the earnings. So drawing in this trend, we do see that there is a break in the trend right now for the stock price. The stock is above all its moving averages, 20, 50, and 200. The RSI is also in the overbought territory. On the volume profile, we can see that the buying starts to dwindle as we are above in the $200 range. I would be looking to open position around the 160, 150 range. From a volume profile standpoint, it seems like the buying starts to dwindle. There are lesser buyers at these higher prices, especially when your price targets are 204, 205, and the stock is at $198. The downside risk is much higher as opposed to the upside potential, and we'll see how that plays out in the coming weeks and quarters. So there you go. Those are the 5 software stocks that I'll be watching very closely in 2024. My goal is to actually build out a portfolio of software stocks which are highly scalable. The solution has been bought by the market, and we can see massive growth in revenue and EPS in the coming quarters and years. So, which of these 5 stocks are in your portfolio, or do you plan to add one of these 5 stocks? Let me know in the comments. And as usual, if you enjoyed today's content, make sure you hit the like, click on subscribe, and ring the bell notification. I will see you next time, investor family, but don't forget to invest for tomorrow.